Welcome. My name is James Barber. I'm your Oregon Cash Flow Pro. Today we're going to talk volatility indexes. These are the type of indexes that you'll find in fixed indexed annuities and indexed universal life, and they're starting to pop up in variable life insurance policies and annuities as well. There are some things that we need to know about what type of environment they perform well in, what type of environment most of them were created in and back tested in, and what we might expect from them going forward or where they might find a place inside of your portfolio. So stick around because we're going to look at the charts of some of these indexes that we can get a hold of, and we're going to see why they did what they did. How are they performing and which ones are our favorites? Here we go. Let's start with the PIMCO Tactical Balanced ER Index. Okay, so a volatility index or a volatility controlled index is, as we can see here with this AI overview, when you do a quick Google search, it's a market index designed to manage and reduce the impact of market volatility. Now, it does this by shifting exposure. You can read through this if you like, but essentially, different volatility control index will do different things. Some of them will shift between equities and cash. Some of them will shift between equities, bonds, and cash, depending on how volatile the market is. Oftentimes, volatility is measured by the VIX when it comes to the rules that these indexes make for themselves. So the VIX hits a certain number, they're going to start shifting more into bonds or cash. As the VIX reduces, or as volatility reduces, they're going to shift back more into equities. And there's a number of volatility indexes available in life insurance policies and annuities. So we're going to look at a few of them here and see how they've done in the recent past. What was the expectation, and why did they do what they did? Let's start with the PIMCO Tactical Balanced ER Index. When you see ER, that is excess return. Excess return means they're going to calculate the return minus whatever the risk-free rate is. Well, in a low interest rate environment, the risk-free rate is very, very low. In fact, a few years ago, it was close to zero. Now we're in a higher interest rate environment, and that risk-free rate is up around 4 to 5%. Just depends on what you can get in the most reliable bond options out there, or treasuries. If we take a look over the last 5 years, this is the chart. Current weighting, 55% bonds, 45% equity. Let's bring up the last year. This one has a very good long-term trend. Actually, let's look at the max of this one real quick. This index actually began right around here, right around 2018. Prior to this, this is back testing, and this is back testing in a low interest rate environment. This is important because when we hop over to some other volatility indexes, we're going to see a drastic shift happen when we move to the high interest rate environment. But this was back tested in a low interest rate environment. It came into being here. And then in the low interest rate environment through 2022, we had really good growth and gains. And then we entered the high interest rate environment, and it basically held flat, dropped a little bit, and then went back up. So we have seen some good gains since we've gotten into the high interest rate environment, which is kind of unusual because most of the volatility indexes that we're going to take a look at today have not done well once we got into the high interest rate environment. This is one of the good ones. In fact, this is in one of my IULs, and I've gotten a couple of 18% returns since the high interest rate environment. One of the highest returns I've seen in it was over 22% last year. I think it was a 23% return one of my clients got. So really good return last year on that particular anniversary. Let's zoom in a little bit and take a look at what's happened over the last year in here. You can see we had significant turn down here beginning when S&P 500 and the market in general started to drop. And then we had a big drop right here. Now, during this period, the S&P 500 lost about 20%. PIMCO was down about 5% during that period. That's because PIMCO was also in bonds, good exposure to bonds. In fact, if we switch over and we look over the last year, we can see that here in March, they were at 71% bonds, 29% equities. That's why it didn't take as big of a hit as the overall equities market did. And when it took the big drop, big, really fast drop in the S&P, they ended up shifting to bonds and cash. When we don't see any equities listed here, that means 40% of this was cash. You got 60% bonds. The rest of it has to be cash because there's no equities. That's what happens when volatility goes up. They have to shift to bonds and cash. And then as volatility dropped, when the equities rebounded, they shifted back into equities. Let's go back to the chart. You can see that PIMCO did not fully recover as fast as the S&P 500 recovered. In fact, if we look at the S&P 500 here was that big draw, and then the S&P fully recovered in 2 months and hit all-time highs, and it's currently up near all-time highs. Meanwhile, PIMCO has not made it back to the all-time highs. Now, it has recovered to this area. We're up above this area, but we haven't made it back to the all-time highs. And it took a while. It's taken 4 months to get back to this point. Why is that? This is the downside of a volatility index in this particular market. Even your best volatility indexes are not going to be able to keep up with the type of rebound that happened in the S&P 500 or in equities in general. Remember, they shifted to bonds and cash here because volatility spiked up. Well, this rebounded so quickly, volatility didn't drop. It didn't drop fast enough that they were able to get back in and participate in the full recovery with the equities. And the bond market also didn't perform in a way that the PIMCO was able to bounce back utilizing the bonds that they were sitting on. So this is a scenario, it doesn't happen very often, but it does happen, where you were better off in the market and not in the volatility index. Now, the way down, we only dropped 5%. So if this had stayed down here, if it had stayed down around the 20% and made a slow recovery, the volatility index would have likely outperformed during this recovery. But when it bounces back this quickly, it doesn't. And there's no way to get around that. Does that mean this particular volatility index is broken or that you need to get out of it if it's one of your allocated options? I don't think it does, unless you think the market is going to continue to do this. If the market's going to continue to drop really fast and then go up again and recover really fast, that's not an ideal time for volatility indexes. However, we did see some good recoveries, and I do have some people that had some anniversary dates around here and got in around this low point, and they're sitting pretty good at the moment. Now, the reason we like the volatility indexes inside of our IULs and our fixed index annuities is because we get a very high participation rate. Because it has this excess return index, the options are a lot less expensive, and so we get uncapped growth. That's how we can get that 18 and 23% returns in a year with these things, even though they're controlling for volatility. So excellent opportunity within the PIMCO. Let's take a look at another one. And this one is going to be more in line with what most of your volatility indexes experience. All right, this is the UBS Balanced Trend Index. Here's where it went live. Prior to this was backtesting in the low interest rate environment. Backtested very good, as all of the volatility indexes did. This was also a pretty good time in the market. The live date for this, about the same time PIMCO went live. And initially, very good performance because we were still in a low interest rate environment during this time. 2022, we entered a high interest rate environment. And what happened? It dropped and it's traded sideways. So this is significantly different chart than what we saw with the PIMCO index. This one is a lot less attractive. Some people have gotten gains because inside of the IULs and the annuities, at each anniversary, you're going to reset to whatever the value is. So if you were in this and it reset to here, the next year you were up and you got to participate in some of the gains. But we did see a significant drop off and we haven't seen a really big run up, and it's all back down again. You can see right here. Here's what it looks like over the last year. Very similar to what we see in the PIMCO. Now, this is likely going to be very similar among most of these indexes if we look at the year to date. Big drop when the equities dropped, slow recovery because it moved away from the equities. It didn't get back in quick enough to get the full rebound. Here's another one. This is the Pace Setter Index. This one went live right when we got into the high interest rate environment, but all of its back testing It's this red line. All of its back testing was in a low interest rate environment. And the back testing looked really good. Unfortunately, it went live right when we hit high interest rate environment, and you can see down and sideways. That's kind of the trend for most of the volatility indexes that we're going to look at today. So not great performance. Again, your anniversary could get you some gains, but obviously this lags the actual market. This blue line was the S&P, and really good returns in the S&P since we hit that high interest rate environment. Here's another one. This is the Barclays Trailblazers Sector 5 Index. This is the live date, back testing in a low interest rate environment. Really good. Actual experience in a low interest rate environment. Very good. High interest rate environment hits here, and we see down and sideways and more down. So this one struggling in this high interest rate environment and in the current market. Let's look at the last year, and we see very similar, except this one still hasn't even recovered back to here yet. So this one's having a really tough time. If you're in the Barclays, you're probably going to want to explore your other options when it comes to your anniversary date. It's possible it couldn't bounce back, especially if your anniversary is around now. Maybe it recovers, but it seems to be struggling even when other volatility indexes have recovered and the market's recovered. So be sure to talk to your agent, see if you may have a better option. Now let's compare that one to our S&P 500 Futures Index, ER. This is not a volatility index, but it is an option in the same IUL that offers that PIMCO index. This offers some good diversification because there's no exposure to bonds. You just have exposure to the S&P 500 that's uncapped, and you can see the return over the last year. It dropped when the S&P dropped, and it fully recovered and is at all-time highs, just like what's happening in the S&P. In fact, this tracks the S&P very well. You can see up 11% over the past year. The actual S&P up 16%. What's the difference there? It's about 5%, which is the effect of that excess return. That's the risk-free rate, which is right around 5% right now. So this is performing right in line with what we would expect in relation to the S&P 500. If we enter another low interest rate environment, like when we go back 5 years, it's going to perform almost the same as the S&P 500 because that risk-free return drops quite a bit if we have a lower interest rate environment. So just something to be aware of. These things are pretty cool. I analyze these things all the time. We look at them every week. If you have some of these in your IUL, you're wondering, your anniversary date's coming up, you have the opportunity to do some changing around, feel free to meet with me. Even if you're not one of my clients, if you have one of these products and what I've already told you doesn't help you enough to decide what you might want to do, I offer free consultations to everybody. Even if you're not my client and you bought these products from somebody else, I'm happy to spend a few minutes to help you out if my videos have not educated you enough. Now, it's my hope that you get enough answers with the videos that I'm putting out, that you don't actually need to schedule some time with me. But some people need a little bit more hands-on than what you can get from my videos, and I'm happy to help out with that. Of course, if you're in the market for these things, you can always schedule a meeting with me, get some illustrations, find out if these type of products, index universal life, whole life, fixed index annuities, any of these things, if you're in the market for those, that's my wheelhouse. I'm into the details. Let's talk. See if I can help you out. If you're already working with an agent and you want to make sure they're designing things properly, you can also check with me on that as well. I don't mind giving a free consultation and letting you know if you've got something that's optimally designed. The most important thing for me and why I continue to put out these videos and be so transparent on this channel is because I know I'm not going to be able to work with everybody out there. We just don't have enough time in the day. But I still want you to buy these products that are designed the best that they can be designed. Because if you do good in them, you're going to talk to people about it, and then they're going to want to buy these products, and maybe they'll come my direction. Maybe I can make a sale in the future to one of your friends and family because I pointed you in the right direction and I helped you save a bunch of money. So if you found this video helpful, hit that like button. Subscribe if you haven't subscribed to follow along. And also, I started a podcast. Me and a couple of other agents are doing a life insurance only focused podcast. It's called the Life Insurance Financial Education Podcast, where we pull back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. Be sure to check that out in your favorite podcast app. We also have a channel here on YouTube. Under the same name, you can watch the videos here or you can listen to them in a podcast. Take your pick. If life insurance is where your interest lies, especially if you're an agent, there's a lot of good information that we put out that could probably help you be a better agent. And if you're a customer or a client, there's a lot of information that will help make sure that you get the optimal designs and you're buying the best products. So I hope that's helpful. Take care, and we'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.